Right now, Meta Platforms, ticker META, is in a state of free fall. The stock is trading live at $662.64. It is a bloodbath. The stock is down an astonishing $89.03, a catastrophic drop of nearly 12% on the day. This isn't a slow bleed. This is a violent, high-volume gap down that is vaporizing market capitalization at an alarming rate. And the immediate story, the one every financial news outlet is running with, is that the company reported disastrous earnings. Anyone glancing at the headlines will see EPS miss and a massive $16 billion tax charge and think that's the entire reason for the collapse. But that is not the real story. The expectation was for a clean report, but the reality is so much more complicated. The tax charge is a one-time, non-cash accounting adjustment. If you strip that out, earnings per share would have actually beaten expectations, coming in at $7.25. The core advertising business is, by all measures, incredibly strong. The real story, the reason nearly $200 billion in value is evaporating as we speak, isn't about the past, it's about the future. It's about management's commentary on yesterday's earnings call, specifically their guidance that 2026 expenses and capital expenditures are going to be notably larger than even the massively elevated spending of 2025. Let's establish the common ground, the narrative that investors held just 24 hours ago. The consensus belief was that Meta was firing on all cylinders. The year of efficiency had worked. The company was lean, ad revenue was rebounding powerfully, and its AI-driven ad platform, Advantage Plus, was clearly working. The stock was a core holding for growth and even becoming a capital return story. People using Fidelity Investments or checking their Schwab Intelligent portfolios saw Meta as a reliable tech giant. The market was expecting a solid beat and, most importantly, stable guidance. They were expecting confirmation that the spending on the metaverse and AI was under control. The reality that just hit the market like a freight train is that the year of efficiency is definitively over. We have now entered the era of AI expenditure. The core advertising business is, in fact, a fortress. Revenue for the quarter was $51.24 billion, a 26% jump, which beat estimates. Ad impressions were up 14%, and the price per ad was up 10%. This is a picture of health, but it simply does not matter. The market has, in the span of a few hours, realized that every single dollar of that ad-driven profit and billions more is already earmarked to be spent on a massive open-ended AI arms race. This isn't about the Quest 3 headset. This is about building super intelligence labs and data centers on a scale that rivals national infrastructure. The market isn't reacting to Q3's strong performance. It is violently repricing the stock for a 2026-2027 spending cycle that appears to have no visible ceiling. Let's look at the trading action itself. The stock closed yesterday at $751.67. The warning about future spending came on the earnings call, and the stock immediately collapsed in after-hours trading. It opened this morning with a massive gap down, blowing through every technical support level. The 50-day and 100-day moving averages are now distant memories in the rearview mirror. We are seeing immense volume, currently at 34.5 million shares traded, already far exceeding the daily average. This isn't patient repositioning, this is panic. This is institutional funds hitting the sell button. This is margin calls. This is a complete and total narrative breakdown. Active traders using the Interactive Brokers trading platform are watching the intraday low of $650.17 like hawks. If that level breaks, there is very little support for a long way down. This is the kind of volatility that devastates retail investors, especially those who might have just bought in using the Robinhood app or SoFi Invest, expecting a simple continuation of the uptrend. This change is everything for institutional portfolio managers. The funds that were starting to treat Meta as a value play, the ones who like the dividend and the massive share buyback program, are now terrified. A company with an open-ended capital expenditure plan is the exact opposite of a value stock. It's a high-risk venture bet. Conversely, the growth managers are now questioning just how much growth this spending will even buy. It directly benefits Nvidia stock, as Meta is one of their biggest customers. But for Meta itself, it's a colossal operating expense that will crush margins for the foreseeable future. This is a nightmare scenario for anyone managing Fidelity Wealth Management accounts who had pitched Meta as a growth at a reasonable price story. Let's be very clear about what the company does. The family of apps, Facebook, Instagram, WhatsApp, Messenger, is the business. It's one of the most profitable businesses on Earth, built on selling hyper-targeted advertising to its 3.5 billion daily active users. This part of the company is healthy and growing. Then there is Reality Labs, the metaverse division. This segment is a known cash burner, losing another $4.4 billion this quarter alone. The market had, for the most part, accepted this, but the new spending is on a different level. It's core infrastructure for AI, which powers everything from the Instagram Reels feed to the ad engine and the future super intelligence Mark Zuckerberg is pursuing. This spending is non-negotiable if they want to compete with Google, Microsoft, and Apple stock, which is building its own ecosystem. But the cost is staggering. The 2025 capex forecast was just raised to $70 to $72 billion, and 2026 will be notably larger. This is the central tension. The expectation was that AI would improve margins and make the ad business more efficient. The reality is that the cost of the AI arms race is so high that it is consuming all of those efficiencies and more. This is why the stock is collapsing even though its core product is performing beautifully. This is a crisis of confidence in capital allocation. Investors doing their own online investment research on investing sites are in a bind. Do you trust the founder's long-term vision, or do you flee from the horrifying short-term expense profile? This is a tough decision whether you're a self-investing expert using Interactive Brokers or a beginner with a Fidelity brokerage account. This level of spending completely reframes the stock. It's no longer in the same category as Apple stock, which is a fortress of free cash flow, or even Tesla stock, which, while volatile, has a physical product growth story. Meta has just declared itself to be in a full-scale R&D war, and the market is pricing it as such. For those with a long-term investment horizon, perhaps in Fidelity IRAs or other retirement accounts, the question is whether to view this as a generational buying opportunity or a sign that the company's best days of capital discipline are over. Many are probably flocking to Fidelity ETFs or Fidelity mutual funds to let a professional manager make this decision for them. The Fidelity mobile app and Robinhood stock trading platforms are no doubt seeing massive sell orders from retail investors who are spooked by the 12% drop. This all comes down to the spending. The numbers are so large they are hard to comprehend. I want to know what you think. Comment below with how much you think Meta's total 2026 capex will be. Will it be over or under $100 billion? Let me know. So, where does the stock go from here now that it's been shattered? The bear case is what we are living through right now. The stock is officially in the penalty box. It is uninvestable for any fund that has a mandate for margin stability or predictable earnings. The stock will likely drift lower until management comes out and gives a hard dollar figure cap on 2026 spending. Until then, any rally will be sold. The SoFi platform, which offers everything from SoFi stocks and SoFi ETFs to a SoFi robo-advisor, will likely see its algorithms reducing exposure to Meta. The stock has broken its narrative, and that's harder to fix than an earnings miss. The bull case, the one that requires immense patience, is that this spending is the right move, that in this industry you either spend to win or you become obsolete. The bull case is that Meta is building the foundational AI that will power the next decade of computing, and that owning this stock at $662 will one day look like a stroke of genius. This is the ultimate bet on the founder investment. This requires looking past the 2026 income statement and believing in a 2030 vision. This is not for the faint of heart, and it's not a trade for someone using Robinhood fractional shares to make a quick profit. This is a thesis that requires deep conviction, the kind you'd expect from a professional using the full SoFi Active Investing or Fidelity Trading Platform toolsets. In the end, today's 12% collapse at $662.64 is not about a tax bill. It is not an anomaly. It is the market's brutal and efficient realignment. The expectation of a mature, efficient cash printer just collided head-on with the reality of an all-in, high-stakes, high-spend gamble on AI supremacy. The ad business is a fortress, but the market is now terrified that the cost